Let's look at the answers together for the formula exercise. So let's kick it off with these ones here, and I'm sure you took all of these off. Let's just do it right now. Shift. All right, cool. And we'll start off here. So before I go into too much detail here, I want to talk about these formulas. And so these are profitability formulas, and they're from the income statement. And the only reason I bring that up is because you start at the top, gross margin, then halfway down, you look at operating margins, right? How profitable is your business after deducting operating expenses? And then what's the bottom line profitability, net profit margins at the bottom? These are from the income statement. And these ones here are awesome because they're from the income statement and the balance sheet. And this is basically telling you for every dollar in assets you have, how much money you're making. And for every dollar in equity you have, how much money you're making, net income, okay? So these are profitability formulas. All right, and I included a couple different years because I always love to look at trends in the data. One data point doesn't make a trend, but a couple does, okay? All right. So gross margin improved, look at that, 200 basis points each year. Remember, 100 basis points is 1%, 200 basis points each year. That's finance nerd talk. All right, so I should probably freeze these panes. And you go to view. So I want to view them differently. Freeze panes. There we go. Good. All right, and let's actually, because we're going to be looking at it here, 14, 15, 16, right? So let's go here. Let me make it a bit bigger so we can all see. Sorry about that. All right, here we go. So gross margins, look at that, getting better. And remember when we were modeling this, we assumed it would just keep getting better because you take a couple of data points in the past, and remember, an object in motion stays in motion. So it looks like it's improving. Okay, cool. Done. Next up, we've got operating margins. Okay. There you go. Wow, it's good. It's getting better too. Healthy looking chart. Oops. Okay. So operating margins we got down here, and operating margins is just EBITDA margins. Okay. And we could have looked at non-EBITDA margins like this one here. And the reason I don't like doing that, right, is because this includes non-cash stuff like depreciation, right? And so when I'm looking at profitability metrics, I like to look at as close to cash as possible. And EBITDA is closer to cash than non-EBITDA operating profit, okay? So it's a percent of sales like most things. And we improved from 37 to 42 to 47. That's great. That's great. What is driving that improvement in operating profit? Let's see here. You got sales, marketing, product development. Okay, sales and marketing is improving 1% each year. Looks like all three of them are kind of almost equally helping out. Okay, that's called leveraging the model. Great. All right, let's go back here. Then what is the net profit? And that's obviously at the bottom. And it looks like it's getting, wow, really good. Really good. And what's interesting here is you can tell that this one is usually lower than that, and this one's usually lower than that. And the obvious reason is because up here, you've only deducted one expense line. It's gross, gross profits, or cost of goods sold, I should say. And here, you deducted cost of goods sold as well as sales and marketing, research and development, and R&D, okay? And down here, you're deducting all that stuff I just mentioned, plus taxes and interest, okay? So 23% net profit margins. Let's go here and check it out. All right, down we go here. Okay, so we've got, it's getting a lot better. Look at that, each year. Oh, we ran it up to 30 there. Okay, cool. Great. Next up, we've got what's the return on assets. That's net income divided by assets. And what's the return on equity? That's net income divided by equity. It looks like this is constant. That's down. I'm not too worried. I'm not too worried, but that kind of looks unchanged anyway. Okay, let's go on here. What's return on equity? Okay, looks like return on equity is getting a bit worse. Inventory days on hand. Can you believe that show is still on TV? Okay, get rid of this. Whoops. Amazing. Okay, cool. All right, so we went from 83 days on hand to 90 to 99. It's a bit of a concern, but given our amazing profitability, it's not the end of the world. Okay. All right, so we got 99 days of inventory on hand. Our profitability is pretty decent, so I'm not too worried about it. And then we've got debt to assets, right? We're looking at total debt. Debt to equity, debt to assets, very similar to these formulas here, right? Except you don't have the income statement incorporated. All right, so we don't have much debt. We're fine. It's actually going down. It's very healthy. Debt to equity, it's healthy as well. We're in good shape here. We got a healthy company. All right, and then we've got the price earnings based on this dude here. Let me just get rid of all these at the same time for us. Okay, cool. So price earnings getting dramatically better because we are a high growth company, very healthy. What's our PEG? This is ridiculously low. Look at that. Bargain. You'll never see or rarely see a PEG that low. Anything under 1's a screaming bias. You obviously know I like this company, whatever company this is. We just made it up. Price to revenue looks pretty darn cheap as well, given the growth rates. EV/EBITDA, right? Looks decent. It's decent, right? But obviously EV/EBITDA is higher than price earnings because you've got EBITDA doesn't include a lot of the expenses that we have in net earnings here, okay? And so EV/EBITDA is, remember, so investment bankers love EV/EBITDA, and so do big companies' corporate finance departments, because big companies that have corporate finance departments are looking to buy other companies. And the reason they look at EV/EBITDA, it's their favorite formula, is because enterprise value is market cap plus debt minus cash and short-term investments. And what that means is this. If you're looking to buy a company and it's publicly traded, what are you going to pay for it? Well, you're gonna pay whatever the stock is at on the market, usually plus 30%. That's a going rate usually. And then what you do is you figure, oh gosh, I got to figure out if they have debt, because I got to pay that debt back. So I'll add the debt. And then you're like, well, if I add the debt, I could probably pay back some of that debt with some of the cash and short-term investments I have on hand. So let me deduct cash and short-term investments. That's why you look at that, right? And if you work in M&A, this is more important to you than this, right? Okay, and you always assume at least a 30% increase in the price of the company, the market cap, at least when you're looking at a potential acquisition. Okay, EV to sales looks pretty good as well. All right, what else do we have? Price to free cash flow, it looks healthy as well. It's pretty good. A lot of high growth companies like ours here don't have free cash flow, or it's very low. We're in healthy shape here. Price to book is, it's attractive, but because we're a growth stock, our company's not cheap, right? And that's why our price to book is way, way, way above 1. Okay. All right. What did I write here? Okay. Company X is the biggest competitor of the company that we are analyzing in this exercise and has the following 3 competition metrics. Okay. So Company X is our biggest enemy. That one's got a PE of 7.9 times each year. Huh. Okay. I guess earnings aren't growing, right? Debt to equity for that company is 99%. Oh, that's pretty darn high. And the net profit margin for all 3 years is 10%. Huh. Okay. They got a heck of a lot of debt, way more than us. What's our debt to equity ratio anyway? Wow, we're really low, man. Okay. Okay. And their net profit margin is 10%. What are we at again? Net profit margin. Oh, we're kicking their butts. And we're growing too, right? Wow. This means they're not growing. They have a lot of debt and they're not growing. What's the PEG of the company, right? So 2015-16, I don't think it's really applicable because there's no growth. It used to be divided by 0. What did I write here? Yeah. 0, no growth. Based on the P, is this a better investment than, okay. I would say our company is a better investment because they're at 7.9 times, right? But there's no growth. So if they're at 7.9 times for all 3 years in a row, and they're probably not going to grow next year or the year after, then in a year or two, we'll be cheaper than them anyway, right? I'll show you. Okay, so if we go up to here, where are we at here? P. Sorry about that. Okay, so we're right here. Look at this. Our P is falling by 50% every year, right? Wow. So that means next year, if the stock stays flat, probably won't, but if it does, that means we'll be at like, I don't know, 8.4 times and then 4.2 times, etc. So no way, man. We're a way better investment than this one. That one's not growing. It's a trap. All right. Is the debt to equity of X better than the company we're looking at? No way. No way. Their debt to equity is 99%. Ours is single digits. Is the net profit margin for this company better than ours? No. They're at 10%. We're way higher. All right, there you go. That's the conclusion of the exercise.